All right. Chapter 13, taxes and insurance. 13.1 is property tax. Here's your objectives. We're going to go through it, so don't worry writing it down. All right. Taxes pay for the following: police protection and emergency response, fire protection and emergency response, 911 emergency service, public schools, street and sidewalk maintenance, snow removal, parks and recreation facilities, activity programs for senior citizens, and libraries. Okay, let's take a hot second and talk about this stuff. I don't know how many times I've been walking down the sidewalk or crossing the street, and you got some pretty ridiculous stuff going on. So obviously, if we're paying for all this in our taxes, then maybe we have a right to complain when stuff is kind of breakneck. Um, Public schools, that's probably one of my biggest beefs. When you get a speeding ticket, which thankfully I have not got one in a very long time, you will see that there are spots for emergency vehicle. The emergency vehicle was nowhere on scene because you only got a speeding ticket, but you will pay a portion of your fine every time to 911 emergency services. It's just something that our country does. All right. Fair market value and assessed value. Fair market value is a price at which property can reasonably be expected to sell. Assessment rate is a rate by which the property is multiplied to find the assessed rate. Assessed value equals the fair market value multiplied by the assessment rate. So let's look at an example. Find the assessed value for the following pieces of property owned by Martha Spencer. So the home fair market value is $298,000. Assessed rate is 40%. So you take the 298,000 times the 40%, and you get 119,200. Business property fair market value, 328,500. Assessment rate 35% is $114,975. I'll give you time to write that down. All right. Commercial lot located in a different state. Fair market value is 123,800 and assessment rate is 60%. So that gives it a fair market value of 74,280. All right. A taxing authority, such as a city or a community college district, first estimates the revenue needed and then finds the property tax rate needed to generate that amount of tax as follows. Step 1, estimate the amount of money needed. Step 2, find the total fair market value of all real estate properties in the tax district. Step 3, find the total assessed value of all real estate properties in the tax district. Step 4, property tax rate equals total amount, tax amount needed divided by the total assessed value. All right, let's look at this example. So find the tax rate for the following school districts rounded to the nearest hundredth of a percent. The amount needed is 14,253,000, and the total assessed is 1,575,890,000. So the tax rate is equal to the amount needed divided by the amount assessed, which is 0.9%. All right. Okay. Here's the next one. Find the tax rate for the following school district. Amount needed, 268 million. Out of the amount assessed, 36,190,000,000. When we take the amount needed divided by the assessed, you get 0.74%. Questions on that? It's literally one divided by the other, and you round to the nearest hundredth. I don't even remember a question like that on the homework. The tax rate is applied to the assessed value to find the property tax due. Tax is equal to the tax rate times the assessed value. That was pretty quick. It's gone already. All right. Some areas express tax rates as a percent of assessed value. The tax on a piece of property with an assessed value of 174,000 at a tax rate of 2.17% follows. Tax is equal to 0.0217 times the 174,000, which is 3,775.80. All right. Some areas express tax rates as the number of dollars per 100 for an assessed value of 56,300 and a tax rate of $11.42 per $100 of assessed value. Find the taxes as follows. So you're going to divide the 500 or the 56,300 divided by 100 would be 563 hundredths. Times the $11.42 is $6,429.46.
Excuse me.
Yeah.
Sorry, I'm gonna have to leave class in a couple minutes. I have to go pick up my dad.
You're okay.
Just wanted to let you know when I leave.
Yep. That's fine. Just make sure you check Canvas for the videos.
Okay, thank you.
All right. Questions on this kind of stuff? No. You have examples here for you, so you can always check back on this if you get stuck on the homework. Some areas express tax rates as a number of dollars per thousand for the assessed value. You guys can see this. It just depends on how you're asked to represent it. So you take and divide the given amount by 1,000, you get 197 thousands. Multiply it by the rate, and you'll be able to know what you're supposed to do because the rate will tell you. All right. Again, here the rate is telling you what it wants. If you see mills like this, you have to divide it by 1,000 and then multiply it. This one is probably a good one for you to write down. Okay. All right, tax rates. The following chart shows equivalent tax rates written in 4 different systems. You guys probably want to either take a screenshot of this or write it down. So here's your percents. Here's your per 100. Here's your, this should be per, oh, they wrote that wrong. Give me a second to help you figure out which one. Okay, so I think the first one's supposed to be per 100. The second one should definitely be per 1,000. Yeah. And then this in mills is another 1,000, but it's different. I definitely double check with your textbook. I'm assuming they just wrote it down wrong on the PowerPoint, but okay. Let me know when you have that written down. All good? All right, property taxes are found by multiplying the tax rate by the assessed value. Find the taxes on each of the following pieces of property. Assessed values and tax rates are given. 58,975 and 8.4%. So you're going to translate your 8.4% into your decimal. And then the tax is equal to the tax rate times the assessed value. So your tax would be $4,953.90. Are we understanding why it's really important, especially for a home, that you pay your taxes as you go? You might not have $5,000 at the end of the year to put towards taxes. Okay. Parts B, C, and D here. The only difference here is you're changing the rate. Here they're doing 782 per 100. So you have to find the number of hundreds. So 68,456 and 28 cents. Per thousands, you have to find the number of thousands and then multiply it. So you get 8,321 and 62 cents. And per mills, you have to find the mills. So 0.094 times the given is 20,844 and 50 cents.
I'm going now. Have a
All right.
nice day.
All right. See you, Tim.
Bye.
Okay. Questions on this kind of example? You literally just have to pay attention to the type of rate that they're giving you. All right, let's look at our last example here for this section. Diego Garcia considers property tax as he decides where to build a 40-unit apartment house with an expected market value of $2,800,000. In one county, property is assessed at 50% of the market value with a tax rate of 3.2%. In the second county, property is assessed at 80% with a tax rate of 35 mils. Find the county with the lower tax. Find the amount saved by building in the county with the lower tax. All right, so property tax for the first county is going to be the 2,800,000 times 0.5 times 0.032, which is 44,800. Property tax for the second county is the 2,800,000 times 0.8 times 0.035, which is 78,400. So the first county has the lower rate, and he's saving 33,600 per year. All right. Any questions on that kind of problem? No? Okay. Okay. Section 13.2, personal income tax. Here's your objectives. List the 4 steps that determine income tax liability. Find the adjusted gross income. Know the standard deduction amounts. Find the taxable income and income tax. List possible deductions. Determine a balance due or a refund from the Internal Revenue Service, and prepare a 1040A and a Schedule 1 federal tax form. These are the tax forms that we're going to see most often. Right now, because of my jobs and working primarily at Sylvan, I fill out what's called still the 1040, but then I also have to do something called a Schedule C. And then there's another one too. I can't remember what that one's called. All right. Sources of income and expenditures. Most of the government's income is from personal and corporate income taxes, which are taxes on income. Most working adults in the United States are required to file an income tax return each year within the Internal Revenue Service. Step 1 is to find the adjusted gross income, or the AGI, for the year. Step 2 is to find the taxable income. Step 3 is to find the tax. Step 4 is to check to see if a refund is due or if money is owed to the government. Step 1, add amounts from all W-2s and 1099 forms along with dividends, capital gains, unemployment compensation, and tips or other employee compensation. Step 2, from this sum, subtract adjustments such as contributions to a regular individual retirement account, an IRA, or alimony payments. Here's our first example. As an assistant manager at the Dollhouse, Jennifer Crum earned $24,738.41 during the 9 months she worked there last year, and $1,624.01 in interest from her credit union. See her W-2 and 1099 forms in text. I believe that means in your textbook. She had $1,500 in regular IRA contributions. Find her adjusted income. So the adjusted gross income is going to be wages plus interest minus her IRA contribution. So here's her wages plus her interest minus her contributions. So her AGI income is $24,862.42. Standard deduction is the amount based on the taxpayer's filing status. So single, married, filing separate, married, filing together, that kind of stuff. Head of household, unmarried person who provides a home for other people. Finding standard deductions, $6,300 for single taxpayers, $12,600 for married taxpayers filing jointly, $6,300 for married taxpayers filing separately, $9,300 for head of household. These numbers vary kind of year from year, so make sure that you are always checking, and you always want to fill out the most current tax year documents. So if you have a tax form from last year, you do not want to use that. You want to use the one for this year. Filing statuses. Personal exemptions. One for yourself, one for spouse, one for each child or other dependent. A dependent is a child, spouse, parent, or a certain other relative to whom primary taxpayer contributes all or a major portion of necessary financial support. Some people might take care of their grandparents. And if you are taking care of your grandparents and not your grandparents taking care of you, then you would claim your grandparents as dependents on your taxes. So filing status and exemptions, total deductions. So single individual, one exemption, you do 1 times 4,050. So the total deductions are 4,050. Married, 3 children, 5 exemptions, 5 times the 4,050 is 20,250. And then single head of household, 2 children, 3 exemptions, 3 times 4,050, 12,150. I should say that most of the time you are not going to do deductions unless you are doing an itemized tax return. Most of us, especially today, cannot really, we don't really make enough to do itemized deductions, so we don't typically tend to do them. Taxable income is found by subtracting the standard deduction amount and personal exemptions from the adjusted gross income. Taxable income is used along with the data from the tax rate schedule shown in the text to find the income tax. As you can see from the tax rate schedules, individual income tax rates range from a low of 10% to a high of 39.6% depending on income and filing status. Here's our second example. Find the taxable income and income tax for each of the following. Herbert White, married, filing jointly, 5 daughters, adjusted gross income of 48,300. So here's Herbert's. He's himself plus a spouse plus 5 daughters is 7 exemptions, gross income times this minus the standard deduction minus the deduction for exemptions. So his taxable income is less than 18,550. So the rate is 10%. So it's going to be 7,350, which is his taxable income times 0.10. So $735. You can see why some of this is a bit ridiculous. Find the taxable income and income tax for each of the following. Onita Fields, single, no dependents, adjusted income is 28,400. So of course you're going to subtract off the deduction and then the exemption. She exceeds 9,275. So it's going to be the 927.50 plus 15% times any excess over 9,275. So her taxable income is $2,243.75. Imogene, single, head of household, 2 children. So that means gross income minus standard deduction minus exemptions, excess over 50,400. So it's 6,897.50 plus 0.25 of the excess. So her total taxable income is 7,560. All right. Find the taxable income for Jeffrey Norwood. Married, filing separately, 1 child, adjusted gross income 145,000. So you're going to take the the separate, so basically filing singly times the 2 exemptions. So then you want to do the 25,895.75 plus 33% of the excess. So his taxable income is $30,804.50. His taxable income is more money than I make in a year. All right, taxpayers may deduct the larger of itemized deductions or the standard deduction from their adjusted gross income before finding taxable income. Again, this is where I tell you that most of us would love to do that, but we don't make enough money. Medical and dental expenses in excess of 10% of the adjusted gross income can be taken off. State and local income, real estate, personal property, not federal income or payroll tax. Interest paid on a debt such as a home mortgage or a student loan is deductible. Other personal interest is not deductible. You typically can know if you can subtract something off because the The student loan company or the home mortgage company will send you a document around tax time that will tell you what you can take off, basically. Gifts to charity has to be eligible charities. So, like, something you find on the internet is not going to count unless it's going to be like something that you super know is a good charity. All right, causality of theft or losses, fire and theft if not reimbursed by insurance company, unreimbursed job expenses, tax preparation, and miscellaneous deductions if total exceeds 2% of adjusted gross income. Christina Kelly is single, has one child, and had an adjusted gross income of $58,700 last year. She paid $3,240 in real estate taxes, $7,280 in home mortgage interest, and donated $1,200 to her church. Find her taxable income and her income tax if she files as head of household. So itemized deductions equal to $11,720. Her itemized deductions exceed the standard deduction for the head of household, so you use the itemized. So if her itemized deductions came up to be less than the 9,000 whatever, then you would use the standard. Okay, same for you guys. If your itemized deductions do not exceed a person filing singly, then you're going to use the standard. Then we also subtract off the exemptions. So her taxable income is $38,880. You're going to take that away. So then we have our $5,183.75 times 0.25, and then the excess over 3,000 or 37,650. So her taxable income is $5,491.25. If the amount withheld is greater than the tax owed, the taxpayer is entitled to a refund. If the amount withheld is less than the tax owed, then the taxpayer must send the difference along with the tax return to the IRS. Jim Clark works as a petroleum engineer for Chevron, where he helps design deep, complex wells being drilled off of the coast of Africa. His wife stays at home and takes care of their toddler. His salary last year was $123,500, and $1,210 was withheld from each monthly paycheck. They file a joint return and use the standard deduction, find the amount of income due to the IRS or the amount overpaid as applicable. So, adjusted income, $123,500, standard deduction $12,600, personal exemptions $12,150, taxable income is $98,750. So his income that is taxable is going to be the $10,367.50 plus the 25% over $75,300 for a total of $16,230. The amount withheld last year was $1,210 for each month, so $14,520. So this family still owes the IRS $1,710. The Clarks must send in $1,710 with their income tax return. They may also owe some state income tax if their state has it. Every year, many rules related to the calculation of income taxes change. This is why I told you to only use the documents that are for that year. Use most current information and forms. Use the simplest form possible. Check with the IRS before choosing the form. The rules often change. Single or married filing jointly with no dependents. No, this is when you use a 1040 easy. No adjustments to income. Cannot itemize. Limited sources of income and use of tax credits. Under age of 65 with taxable income less than $100,000. Taxable interest is not over $1,500. Sources of incomes. This is for the 1040A. Sources of incomes limited to wages, interest, capital gains, and other categories Limited adjustments to income and use of tax credits cannot itemize taxable income less than 100,000. A Schedule 1 form is sometimes required to be attached for items such as interest over a certain amount. See the example in the text. Again, I believe that is your textbook. Okay, so that is it for this portion of Chapter 13. We will cover the remaining Chapter 13 next week, and they will be posted up on Canvas.